You're very well aware that PostBank is 100% owned by the government, and the majority shareholder of the institution is the government of Uganda with 100% shares. So as an institution, we align ourselves to ensure that we meet the objectives of the government. One of the things is ensuring food security, improving the livelihood of our people through income generation. And when you find that over 70% of the population in Uganda is engaged in agriculture, you find that majority of the population is engaged in farming, and they are mainly smallholder farmers. So for us to improve the livelihood of smallholder farmers, we have to ensure that we provide access to financial support, that is agribusiness support, accessing finances, so that they can be in position to scale up their production amid so many challenges. So one of the risks that we face as an institution, especially given the production value chains that we offer, there is a lot of uncertainty in weather. We have the weather risks. These days we don't know when to start planting, when the rains will be starting. So it's just even if they provide us with a weather calendar, especially the planting window that is shared by the ministry, also shared by the insurers, still you find that it's not uniform in different areas. Some areas might start planting in March, others might start in April, though some have started weeding. So the weather risks extremely have affected the sector, especially the production sector. Then we have what we call market risk. Market risk whenever we have access to market, especially whenever we have bumper harvest for a specific value chain, you find that the prices are extremely too low. Any that a customer starts wondering, when should I really sell this produce? Because you might find that the current prices might not be in position to recover the loan. So such facilities, we find the bank has to meet the cost of extending their payment by a month or two as prices stabilize. And also you find that we have players who are aggregators, that whenever we have bumper harvest, these aggregators take advantage of our farmers and they dictate prices. The reason being, we've not embraced so much contract farmers for contract farming, especially when it comes to smallholder. Contract farming is embraced by mainly large-scale farmers and registered institutions that are in production that can get contracts from specific off-takers. But for smallholder farmers, unless they are in cooperatives, or farmer groups, where they aggregate and get a specific off-taker, where they can have an agreement on which price. But majority of our smallholder farmers do their farming independently. So they do not have the mileage, or they do not have the advantage of negotiating for prices. So you find that the bank is hit hard, especially when it's time for repayment. And farmers cannot sell at a loss. So a bank ends up extending the loan periods. And the extending the loan means, one, you are affecting the customer because they will pay more interest. So also the bank is postponing the interest that would have earned at that particular time. Then also we have production risk. When it comes to production, most of these smallholder farmers who lack the knowledge, the current knowledge, that you find some of them are still skewed or stuck with their traditional way of farming, whereby some of them don't want to access inputs such as fertilizers, fertilizers, and also accessing specific inputs like improved seeds that have been developed that can accommodate the short-term maturing seeds. They feel that they are kind of so much expensive for them. Then also they lack knowledge and access to finance. Some of them even have they fear to approach banks because they feel that such products, so some banks cannot provide such facilities in terms of giving well-aligned loans that are concessional loans. So what the bank has done to mitigate these risks, one of the things that the bank is, when it comes to agri-financing, you cannot do it as a bank. So really you need to get more partners. You need to get a partner whereby you can share the risk, you can transfer the risk, okay? And also whereby both of you can come into agreement. Like for instance, when it comes to this sharing the risk, that means in case of any loss, you can share the loss with our partner who comes in to meet the, like now when it comes to insurance, an example is insurance. When we have calamities such as weather, floods, drought, and with the partnership that we have with different insurance companies, such as CIC, when such calamities occur, they come in and compensate the farmers. Therefore, the farmer will not be in position to make 100% loss, okay? And the bank also will be in position to recover part of the funds. Another thing that we have is shared capital, where a partner can capitalize part of the, like for instance, we have partnership with the government of Uganda through Bank of Uganda, where we have ACF loans, agriculture credit facility. The reason why the government came up with this, it wants to commercialize farming, and it wants to ensure that commercial farmers or farmers within the country can access affordable credit. And their affordable credit mainly is at 12%, which is lower than the commercial rate, and also 15% for traders, depends. So that means also the government is in position to give 50% back to the bank for that particular loan that has been disbursed. So that means the bank will be in position to incur a cost of capital. Risk is 50%, and the other 50% is made shared and contributed by the partner. So these loans have helped us so much, especially in scaling up our agricultural portfolio. Also, it is affordable. It's affordable to farmers because of the low interest rates, and even the terms are favorable. For instance, we have both smallholder farmers also catered for under block allocation. It's not only looking at mainly the large-scale farmers, but also smallholder farmers have been catered for under block allocations, whereby these farmers come and access funds as a block. Though we finance individually, but it's the block that we report, and the partner is in position to give us 50% of that particular block that we've submitted. It even helps you in such a way that one, the group helps you to put the farmers together, and you find that they have a common goal. Maybe they are participating in a specific value chain, maybe maize, maybe soya. So financing such a group becomes easier for a financial institution. When it comes to sharing of the risk, again, we have a partner called ASELI Africa. ASELI Africa are market catalysts. Market catalysts in such a way that they are supporting financing to SMEs, mainly agri-SMEs, because the cost of origination and cost of funding is quite high. So what ASELI did, origination, like when you're originating the loans, when originating the loan in terms of going for appraisal, you're going to appraise the customer. Onboarding a loan, there are so many costs that a bank incurs. So when ASELI realized that in such, you find that the returns on that particular loan to a bank becomes lower. Some even is at a loss, but bank cannot realize that this loan we originated it, but because of the cost that we invested in, they cannot analyze that they gave that loan at a loss, they have not given them returns. So what ASELI has done is that, given that they are market catalysts, there are so many things they've done. One, they've offered us what we call a first loss cover. Then we have what we call originating incentives. Now, originating incentives, which helps us support us in mitigating or reducing the cost of origination. Then what we have also is the third one, the technical support. Technical support mainly is both to the bank and the customer. So technical support, like as a bank, they help us in capacity building, training, maybe if you want to develop a product, okay? Maybe you want to improve on your operations. So they support us. They have through their, through their consultants, they support the bank in offering the service, ensuring that they empower the staff through trainings, especially agri value chain trainings, and also customers themselves. Now, what happens with the customers is that one, the technical assistance that is given to these customers in terms of management of the farm, tracing their cash flows, improving performance of the farm, especially for smallholder. Yeah, so then we have ABI. I've talked about ABI. ABI mainly, one, we partner with ABI, and mainly they want to increase the value that we give in terms of agri-finance. One, we know we have a challenge of collateral. Most people have a challenge of collateral. You might find a client is in business but is not meeting the collateral values of the bank. So for customers that have insufficient collateral, normally ABI supports them to access. Instead of a person, because the person was supposed to get 100 million, so since the collateral was not sufficient, maybe we are going to give 50. So for such customers, ABI comes in and we can finance 100% of their application because we have a partner that is sharing that risk with us. So we finance that person, the entire fund that they've requested for. So mainly they have helped us in, and their main interest when it comes to these smallholder farmers. That's where much of the beneficiaries are for ABI. These people don't have collateral. If they have collateral, they are not sufficient. If they are not sufficient, one, also their location. Two, they are providing family land. If you like a smallholder farmer mainly, much of them, the land they're farming on is communal. So they cannot even offer it as collateral. Even if they offered it, there's no way you can come from another place and buy land within a certain family, though they own it. So it becomes very hard. So you find that a bank mitigates that risk by ensuring that maybe they give the loan values based on the risk. But because we have a partner that can come and accommodate that and share that risk with us, so we comfortably finance such customers who have insufficient collateral, but the business is available, the cash flows are there. These are ABI, they want to ensure that we promote and commercialize production and farming. So they are trying to encourage banks themselves to ensure that they finance to agribusinesses, okay? Agribusinesses located in areas that are marginalized, okay? Like you look at women, youth-owned businesses, people in camps, okay? Those are refugees. Now you find that financial institutions do not dive in so much to lend in such areas. You very well know that much of the land production right now is upcountry for agriculture. And there is a lot of risk there in terms of collateral. Those people don't have collateral. So to encourage banks to finance those people to produce, they came in to ensure that the bank shares that risk with them and ensure that they fund the people with sufficient collateral. So the bank is comfortable because it has a partner that is ready to share that risk. So the bank transferred part of the risk, that is 50% of the risk, to the partner. We do train farmers. One of the things we have, like I said, we have what we call regional agriculture forums that we conduct as an institution. Also through the partnerships, like I've said, the capacity building that I've talked about entirely benefits farmers. This capacity building in terms of how to manage, how to go about the agronomical practices, the timing, how to manage their farms and cash flows better, and also manage the cost of the farm so that they can realize the impact and the rewards from their ventures or projects that they're engaged in. So we conduct our regional farmer forums every quarter in different regions, and we engage different stakeholders. We have opinion leaders, district leaders, Even we partner with NGOs. And you know, a bank has so much the financial aspect, but when it comes to maybe other aspect of business management, when it comes to agronomic practice, we partner, we onboard or we partner with agronomists, specific agronomists that help us in skewing and ensure that we pass this information to our farmers. This forum normally take a week or two in different regions, and when we get specific opinion or leaders in the cooperative, opinion leaders, district leaders, those are the people who go and disseminate this information. Now, because we cannot have all the farmers come together. Already, as a bank, we have products with low interest. The only thing why we conduct this forum is to ensure that these people get the exact knowledge that can help them manage and produce. So we reduce on the risk in terms of production for people who have gaps in the knowledge. We manage this risk by ensuring that they are trained and acquire the right skills to apply, especially when they are growing specific value chains. Time of planting, when are you supposed to weed, which market, which access, which off-takers are there. We even link them because we said we have so many players that come into those trainings. We invite off-takers, we invite input suppliers, different people come together in that training so that we can link them up to markets, link them to off-takers, link them to input suppliers so that they can easily access the services. In so doing, we are also reducing the risk because one, they will access the right information, they will access the right inputs that they are supposed to apply as an institution. First of all, our agri-finance business, the repayments are based on the cycle of the project, the business cycle of the project or the value chain we are financing. We do seasonal loans, okay, mainly for people in production. For people in trade are different because we have agribusiness traders. We have those who bulk also. There are those who bulk and then they sell. There are those who purchase directly and sell. Then there are those who produce. When they produce, maybe they wait until when they harvest and they sell. So we structure our loans based on a cycle of the value chain or of the business we are financing. For instance, we have what they call them grace period loans. For people in production, on average, normally, it's around 5 to 6 months. Then they have paid back the loans. So we tag the loans payment to the cash flows of the business that we financed. Because look, this person does not generate money on a daily. This is a person who is going to start by clearing a bush. After clearing the bush, maybe he comes for funding to purchase seeds, to do the weeding, to do the harvesting, maybe fertilizer application. So our payments are tagged on the projects that we finance, and mainly we have what we call seasonal loans for people who are in trade. There's what we have revolving line of credit, okay? Revolving line of credit where they pay as at when, and they take the money as at when they need, and they pay after a specific cycle when they're selling in the market. Yeah. So, but also before we go into that, you need to have been, as a bank, for us, we don't just finance a person who is a startup. One, you need to have been in this kind of business for some time. For people in production, not less than 3 seasons. Not 3 years, but 3 seasons. Because when you're doing projections in agriculture, you look at the average of the past 3 seasons to help you predict the next yield. So normally you need to have been in that business for at least a minimum of 3 consecutive seasons in that very particular value chain. Because one, you know the risks involved and you know how you've been mitigating them. Unlike a person who has come for the first time, he doesn't know exactly which risks are involved and you cannot tell how much that person will be in position. But if you have the yields for the past 3 seasons, then you can easily try to project the yields that you expect when you finance the customer. So you need to have been in that business before we finance you. For startups, we don't do startups. However, if a person has other businesses, you might, like he has said, he has a person dealing in trade. He has a business in Chikugo, but he wants to start this other business that he has never done. So the cash flows are transferred to the current business that has. Then we can help you do the finance your startup. As long as you have cash flows that can pay, for that particular startup venture that you're venturing in, we can go ahead and finance based on other existing cash flows that are visible. Yeah, so that we can help you align yourself to the business that you want to start. One of the biggest components when it comes to agri-financing is monitoring of loans. If you're not ready to create an environment where people monitor agricultural loans, then I want to assure you, your portfolio is bound to go bad. So monitoring loans starts from onset when a client applies. When a client applies, you have to go and assess to find out whether the information the client has given you is right, is in the field. When you go to the field, you go to validate the information. To validate the information helps you to make a judgment whether you can finance this person or not. The moment this loan is approved and booked in the system, first of all, you have to mitigate the risk of diversion of funds. Yeah. Because one, these funds of agriculture are applied at different stages. Now you cannot say that a person has come for 10 million, okay, and you're giving him the 10 million once. This is a person who's supposed to start by maybe, if he has done the plowing, because that's not always the stake that we request the minimum for a person to have to do the plowing. If the person has done the plowing and he needs to do the planting, the weeding, okay, fertilizer application, harvesting, okay, you cannot get that man and give it to him once. Otherwise, he's going to do the first two activities and you will not keep the money there, you will divert the money. So one of the things we do is to ensure that we give these funds in tranches as per the budget. And one of the qualifying factors in agribusiness as you're planting, as you apply, you should have a very clear budget. The budget that is not overestimated and the budget that is not underestimated. Okay? Now, the bank will release funds based on the budget and the activity. Reason being, it will be reducing on the element of diversion of funds. So each time that they are supposed to release the next tranche, person has to go to the relationship manager or credit officer, goes to on ground, confirm. We gave you seeds to be planted on 5 acres. Are they 5 acres, not 3? So that in case we realize that the funds are not applied, we reduce the risk by ensuring you stop the loan at that, and at least recover the other money, than us exposing the entire money to be lost. Now, if you've done that, they come and make a report. When they make a report, then the committee agrees that let's release the next tranche. Now, when we release the next tranche still, when you're coming for another tranche, you will go back to assess whether the funds are in. Now, that element brings in consistent monitoring. Also, even after the loan has disbursed and those activities, the officer continues monitoring. Now, the monitoring mode of our credit officer is different. He might not be going specifically to monitor Julius, who is in, maybe, let me say, Luzira. The farm is in Luzira. But as I pass through Luzira, and maybe I'm going to Chitintari, no, I'm going to Chirombe, I'm going through those farms, I can be in position to say, oh, that is Julius's farm, okay, it's doing well. I can be in position to say. Now, in case of any calamity, okay, the officer should be in position to identify that such and such an area has been hit. And you know, for you to access the insurance, you need to report the calamity there and then. You cannot come and report a calamity after 2 months when even the bush has grown and there is no evidence that crops were washed away. So it calls for constant monitoring. In the due course of constant monitoring, you're in position to see where the client is going wrong and to see how best you can mitigate them and improve. So the element of monitoring is very key, not only in agriculture, but we emphasize it more in agriculture, given the risk element involved. We have experience of farmers that we've graduated, but we will graduate farmers based on their capacity and experience. We have people who have land there, over 100 acres, but they cannot manage those acres. One, because of maybe the capacity they have in terms of machinery. So a person currently can maybe operate on 20 acres. Maybe in the next season, he can come for 30. By the end of the 2, 3, 4 years, the person now is operating the entire 50 acres. Such a person, even if you find such a person now has acquired a tractor as an addition because of the production increment. He has increased this acreage, so he needs now a tractor. He has realized that hiring a tractor is a bigger cost than doing what? So he comes for an asset finance and agriculture, and also a production loan that is seasonal. So you find that we also structure the loan based on the purpose. A person who is coming for fixed assets or capex, he wants to construct a store, he wants to put up silos, he wants to acquire a tractor, he wants to hire a harvester, he wants to have maybe a boom sprayer. Now, those assets do not generate income on the farm, but they promote efficient activities and production on the farm. So what happens? Such loans, we spread them. We spread their payment based on the cash flow on a seasonal basis. Because one, that particular asset does not generate income directly, but it facilitates a production and it scales up production of a specific farmer. So, like you say, the structuring on the loan also depends on the purpose and where you're going to. The purpose very much. But if you're coming for a loan of production, you can structure it seasonal. If you're coming for maybe asset finance, we can give you a term loan that may be spread over 2-3 years and you pay every season. So that does not constrain your cash flows. Traditionally, majority of people knew that when you're coming for an agri loan, it was mainly for production. That was primary production. That was the traditional lending. But we know we've shifted away from traditional lending and we realize that we do value chain financing. So when you do value chain financing, it will keep you in the cycle of lending throughout the year. When it's time for production, you finance the producer. When it comes to trade, you finance the traders. When it comes to processors, you finance the processor. Then we have also transporters who transport this agri-produce. Okay? So as a bank, our financing model in agriculture, we adopted a value chain financing model. We finance different value chains based on the timing. When it's time for production, we find that we are skewed to financing people who are producing. When it's time for marketing, we finance people who are in trade. And for traders, we have two types of traders. We have traders who bulk, and we have traders who do direct trade on a daily basis. So for those who do direct trade, their loans are structured whereby they have to pay us as at when they make sales, maybe per month. But for those who do bulking, people bulk for 3, 4, or 6 months, depending on the value chain. So we also tag their payments on their business cycle. Then for processors, for instance, people who are adding value, people who process portion, animal feeds, those ones also we do finance them. Then we also finance people who are in the value chain of transport. Okay? People who are doing transportation, they are acquiring trucks to transport produce, maybe banana or matoke from Mbarara or whatsoever, to the market centers where they have off-takers. So those ones also we do finance. So the bank adopted the model of financing the value chain so that we are in constant financing throughout the year. That we are not at a specific time redundant that now, since now the producers are done, so agri financing has stopped. No. So we adopted the model of value chain financing, and this has helped us. In fact, when you do value chain financing, people who are SMEs who take bigger tickets of what? Bigger tickets of loans are those who are in trade and processing. You get, those are the people. So that has helped us to scale our portfolio. Like I said, right now, our portfolio since 2020, when we transformed the bank to become, when we got a vision of the bank becoming an agri bank, we've grown by over 80 as a portfolio, 80%. So this is becoming what? This is becoming one of our greatest what? One of the value chain that we finance most when it comes, when you analyze our financing. Majority of the loans are agri loans. One, because the bank is aligned to ensuring that we improve the livelihood of the people of the country, and that is mainly, if you want to touch that, you have to do agri financing. So, tremendous, our portfolio has grown significantly, and in fact, not even doubled, but it has tripled based on what we had previously, before the bank aligned itself, prepared itself as to become an agri bank. One model, so we are, as a bank, we are doing sustainable agri-financing. We want to do sustainable financing. One of the things that we want to comply with the ESG, the environmental, social, and what? Reason being, We want to finance people that have impact in their communities, socially, that do not affect the environment, okay? But also, these people have impact in terms of job creation. We don't want to finance people who are depleting the environment. So we are looking at the element of sustainability, and that's where the bank is now aligning itself to ensure that we do financing that is sustainable. For us at the bank, right now the biggest opportunity of financing under the bank and the industry right now, agriculture. People have exhausted people in the trade, people have exhausted real estate, but the opportunities that are available are in agriculture. I want to assure you, if you do your analysis, right now, the so-called big banks that were not doing micro-lending are aligning with themselves to start lending to micro people, because that's where the opportunity in the market is. So many partners, all partners right now that come into the market are financing agriculture. Agriculture that has impact to the youth and women, that alignments. So right now the opportunity that are available in the market is financing to agriculture. If you want partnerships, you have to align yourself to agri financing, be it green finance or sustainability, but it has to be in agriculture. If you want any funding, like I've said, it has to be in agriculture. Most of the partners that are interested to partner with the banks are people who are aligned to agri finance. Okay, so there is a big future. Even the government itself, the government is doing a lot to ensure that we promote agriculture finance. For instance, one of the things that I want to talk about today is what we call large-scale commercial farmers. Large-scale commercial farmers is a product that has been developed by Ministry of Finance through the Grain Council, Uganda Farmers Federation, and the Ministry of Agriculture. They want to promote commercialization of food security, food production in the country. And they want to meet interest payment. They are meeting interest payment for loans for people who are operating on 50 acres and above. And these have to be registered entities. Now, people who are operating in 50 acres and above, and they are dealing in specific value chain, we have maize, we have beans, we have soya beans, we have sorghum, and hay. Hay also, they want to ensure we have food security for animals. Now, these people are supposed to come and access funds from the bank, and there are 3 government banks that are doing that. That is, PostBank is leading. We have the biggest chunk of the funds. We have Housing Finance and Pride. Now, the government is going to pay interest. In other words, these people are going to be servicing only principal. The interest is paid by the government to the banks. The reason being, they want to ensure that they increase food security, ensure that there is food security in the country, both animals and also human. And also the reason why I think they're interested in registered entities, I think they want to ensure that we have these businesses registered so that we can have the impact both in the economy and also tracking our production statistics in the country and taxes. Now, these loans are mainly for those value chains, but as long as you're dealing in those value chains, there's specific value product that finance. Maybe you want to asset finance. As long as you're doing asset finance, you want to buy a tractor, but you're going to do that value chain. Okay? You want an harvester or irrigation system, but it's irrigating those particular value chain. So right now, that is the newest partnership that we have. That we are right now running, financing large-scale farmers with registered entities that are operating on not less than 50 acres of land. So what does it mean? That the government is trying to ensure that it promotes food security in the country by subsidizing. People have been complaining that no, the interest rates of the banks are very high. Even the 12% minimum, they are still, by the way, literally it's high. Though for us we feel that it's low, but the 12% is very high if you compare to other countries that are promoting agriculture. Now the government said, no, let us start with large-scale farmers and let us concentrate on specific value chains. Go pick money, pay your principal, we shall pay the interest. So you see that there is a lot of interest even in the government itself to ensure that it promotes agriculture. And I think the government is getting aligned these days to see that we promote increase in food security by ensuring that we support the farmers. For so many programs that are coming up, there's what we had Grow mainly. We have Grow loans, I think you've heard of them. And we are one of the banks that is participating in Grow loans, mainly financing women entrepreneurs, both in business and agribusiness. Okay, both in business and agribusiness. And mainly businesses that have impact on women-owned businesses. Okay, the interest is low, as at 9.2. For us in the bank, it's at 10, but 9.2. And a lot of women have benefited. In fact, we used to think that women are not there who can borrow, but we normally have this money exhausted. Even right now, we have applications. It's because the funds are released in tranches, but we have applications and they're overwhelming. PostBank is undertaking so many activities, but one of the impact that we are trying to have in the community is to ensure that we finance agriculture, and mainly we want to improve the livelihood of Ugandans. So as a bank, we are fostering prosperity for Ugandans and to ensuring that their lives are improved in terms of income generation and also impact in the economy. That's why we want to grow and prosper with our customers together, so that we move the same journey and in ensuring that we improve the livelihood and grow the economy and have impact for both our lives as an institution, as our farmers, and also the bank meets its targets and have impact on the financing. Thank you.